Welcome everyone to your first quarter portfolio commentary video. We're going to cover a couple of different topics such as the market, housing trends, unemployment data, yield curve analysis, and the bond market. Let's start off with the market analysis for stocks. We saw a huge sell-off occur in December in the market as predicted. We saw a lot of contraction come in the growth sector, which is heavily comprised of tech stocks. What we also witnessed was a technical indicator appear called the death cross. This is an indicator signals a sell signal and occurs when the S&P 500 50-day moving average moves below the 200-day moving average. The death cross indicator has proven to be a reliable predictor of some of the most severe bear markets in the past century, notably in 2008. Notice at the beginning of 2008, the 50-day and 200-day moving average of the S&P 500 intersect, signaling investors should move out of risky investments. It was not until July of 2009 that a buy signal occurred when those 2 points intersected again, letting investors know it was all clear to move back into stocks. Since then, the market has had a few sell signals, but had buy signals which occurred soon after. Based on these technical indicators, we've had a few investment managers known as tactical managers exit the market and send their funds proceeds to treasuries. These fund managers are Power Dividend Fund, Power Momentum Fund, and Catalyst Lions Tactical Fund. Tactical managers aim to avoid market downturns by selling out of the market to avoid bear markets. It remains to be seen if selling out of the market was the right decision, as there recently has been a nice recovery to the stock market. However, there are other factors that give us cause to consider remaining in a more defensive posture. On top of the global growth concerns and the tariff situation, there are other signs pointing towards possible trouble for stocks in the near future. One of those are housing starts, which have been a key indicator of looming recessions in the past. Housing starts have begun showing signs of weakening as shown in this chart. Notice past recessions depicted in gray, with housing starts slowing several years prior to those recessions occurring. Now, we don't see a big drop in housing starts. We just see a leveling off occurring with a little bit of a leg down. So it's something that we're going to closely monitor. Another piece of data shown here shows how recession risks rise as unemployment falls. The logic is that once full employment occurs in a cycle, which is approximately 5% unemployment rate, a tight labor market starts to push up costs, and eventually that leads into a recession. On average, there's been about 2.5 to 3 years after full employment has occurred where a recession has begun. The US economy hit full employment rate in May of 2016, which would suggest a recession in May of this year. Now that's highly speculative, as there's been longer periods of time before recessions occurred, as in the 1990s, where there was 56 months that passed between full employment and the next recession. But it's certainly data that we're going to watch, as it shows that we're getting kind of close to that next recession from occurring. We just don't know when on this data. But another piece of data that is closely watched, which has signaled recessions in the past, is a phenomenon called an inverted yield curve, characterized by short-term rates moving higher than long-term rates. An inverted yield curve has predicted the past 7 recessions. So far, the closely monitored spread shown in this chart between the 10-year Treasury and the 2-year still remains in positive territory. However, we've been observing it inching closer. So what you're looking at is these gray bars, which depict recessions. The blue line is a yield curve. The red line is when the 2-year and Treasury and the 10-year Treasury equal each other. So if the blue line is above that red line, the 10-year is paying more than the 2-year. But if the blue line comes below the red line, that's when the 2-year Treasury is actually paying more than the 10-year. That is not normal when it comes to interest rates, and it shows signs of weakness in the economy as well as problems in the bond market. So that is something that's getting closer and closer to inverting as the months have gone by. We have a 0.17% spread at this point between the 2-year and Treasury. So it's something that we're closely monitoring since it's had such a kind of a predictor for recessions in the past. Of course, weakness in the economy is usually good news for the bond market. And the latest positive news for the bond market is that the Fed has suggested that they're going to take a wait and see approach to rising interest rates. This should help the bond market improve going forward as rising interest rates have hurt bond values. We've seen the market for bonds trending up, and we've adjusted our future outlook on bonds as favorable. Clients who consider themselves conservative or are getting ready to retire or in retirement can now use bonds to provide a pretty good income source and to manage risk in their portfolio. So let's recap. We believe the economy is beginning to show signs of weakening, and a cautious investment approach should be used moving forward. With that being said, we don't believe that that means one should panic and ditch their investment plan. The portfolios we've designed and are diversified and have begun to adjust towards a more defensive posture. More importantly, we believe that sticking to a long-term investment objective is the most important mindset to have when it comes to managing one's retirement portfolio. We'll continue to monitor your accounts and send you timely updates and recommendations as market conditions develop. We also encourage clients who have not watched the video on how discretion can be set up on your accounts to make timely adjustments to give it a watch, as we believe that this can enhance our servicing on your accounts moving forward. As always, if you have any questions, concerns, or comments about your portfolio, please feel free to reach out to us. And most of all, we thank you for your trust in your business.